program is the Active Center.
Have you ever looked at your grocery bill and just winced? Or maybe you've noticed that filling up your gas tank feels a lot more painful than it used to. Well, you're not imagining things. That feeling that your money just doesn't stretch as far as it once did is very, very real. So let's get into it and figure out exactly what's going on here. You know, for a long time, decades even, prices were pretty stable. And then all of a sudden, it felt like everything, everywhere, got way more expensive all at once. The big question, the mystery we're going to solve today is why? What was behind that sudden, sharp spike that we all felt in our wallets? And here it is. This is the number right at the heart of our story. In 2022, the inflation rate in the U.S. hit a pretty staggering 8.5%. Now, that was the highest it had been in about 40 years. That is not a small number. It represents a huge jolt to the economy and, of course, to our daily lives. To really get a sense of how big that number is, take a look at this. For decades, inflation just kind of hung out in this comfortable 2 to 4% range. So that 8.5% spike in 2022, that wasn't just a little bump. It was a massive departure from the norm. And it really shows you just how wild and unusual that period was. Okay, so to figure out why this happened, we've got to get on the same page about what it even is. So first things first, let's define the term that's at the center of this whole thing, inflation. What do economists actually mean when they use that word? So here's the textbook definition. Inflation is a sustained, broad increase in prices all across the economy. And the key here is that it's not just one thing, like the price of coffee going up. It's this general rise that reduces your purchasing power. But simply, it means that every single dollar you have buys a little bit less than it did before. This right here, this is probably the simplest and most powerful way to get your head around what drives inflation. Just picture an auction, right? Suddenly, everyone in the room has way more money to spend, but the number of things up for sale hasn't changed. What happens? People start outbidding each other, and the prices just get driven up and up. That, in a nutshell, is the basic idea. So, we know what inflation is. Now let's play detective for a minute and unmask the usual suspects. When it comes to what causes prices to rise, economists generally point to three main culprits. And here they are. The three big drivers are demand pull, cost push, and built-in inflation. Now, each one works a little differently, so let's break them down one by one. And we'll start with demand pull. This is that too much money chasing too few goods idea in action. Demand pull inflation happens when everybody wants to buy more stuff than the economy can actually make. Think back to the pandemic. A lot of people got stimulus money and our buying habits changed. All of a sudden, people had more cash to spend on things like cars or home goods, but the supply chains were a mess, so you had this huge demand crushing into a really low supply. What happens? Prices just shoot up. Now, our second culprit, cost push inflation, is a little different. It comes from the supply side. This isn't about how much people want to buy. It's about how much it costs to make the things they're buying. So when the price of essential ingredients like raw materials or even labor goes up, it just gets more expensive to produce everything. And here is a perfect real-world example we all just lived through. When global events caused oil prices to skyrocket, it wasn't just gas that got more expensive. Suddenly, it cost more to ship goods to stores, it cost more to run factories, and it even cost more to make plastic packaging. And, businesses don't just eat those costs, they pass them right along to you and me in the form of higher prices. Our third driver is kind of like a psychological loop. It's called built-in inflation, and you might hear it called the wage price spiral. It works like this. If you expect prices to be higher next year, you're going to go to your boss and ask for a raise to keep up, right? But then, when businesses have to pay everyone higher wages, what do? Well, they raise their prices to cover those new costs. This creates this self-fulfilling prophecy where just the expectation of inflation can help it stick around. Okay, so we've got these major forces pushing and pulling prices up. But how do we actually get a specific number, like 8.5%? I mean, how do economists take millions of different price changes on millions of different products and boil it all down to just one single number we can track? Well, the main tool they use is called the Consumer Price Index, or the CPI. The easiest way to think about it is like a gigantic official shopping list. The government tracks the price of this whole market basket of stuff, everything from groceries and rent to plane tickets and haircuts. By seeing how the total price of that basket changes over time, they can calculate the overall inflation rate. All right, now this formula might look a little intense at first glance, but I promise you, the idea behind it is actually really simple. Let's just walk through a quick example to see exactly how it works. Okay, let's say that back in 2011, you bought a new microwave, and the price was a nice round $100. That's our previous price in the formula. Now, fast forward 1 year to 2012. You go to buy the exact same model of microwave, but this time the price tag says $105. That's our current price. So you just plug it in, you take the new price, $105, and subtract the old price, $100. That's $5. Then you divide that $5 by the old price of $100, which gives you 0.05. Multiply that by 100, and there you have it, a 5% inflation rate for that microwave. The CPI is just doing that same basic math, but for thousands of different items all at once. So we have this number that tells us how fast our cost of living is going up. But, just measuring the problem isn't enough, which brings us to the next huge question. In the United States, whose job is it to actually do something about inflation? Well, that massive task falls to the nation's central bank, the Federal Reserve. Now, what's really interesting is that the Fed's goal isn't zero inflation. A little bit of inflation, right around 2% a year, is actually seen as a good thing. It encourages people and businesses to spend and invest their money instead of just hoarding cash, and that keeps the whole economy humming along. The problem is when inflation gets way off that target, like it did recently. So how does the Fed control this? Well, it's a constant balancing act. When inflation is running too hot, the Fed's main tool is to raise interest rates. That makes it more expensive to borrow money for a car or a house, which cools down spending and slows the whole economy. And if the economy is too sluggish, they do the opposite and lower rates. The big risk, though, is that if they raise rates too aggressively to fight inflation, they could actually tip the economy into a recession. It's a very tricky tightrope to walk. So this really sums it all up. You've got inflation, where prices are going up. You've got its opposite, deflation, where prices fall, which actually sounds great, but it's usually a sign of a really weak economy. And then right in the middle, you have that stable 2% target that policymakers are aiming for. It's also really important to remember that inflation doesn't affect everyone the same way. It really hurts people who save because their cash is worth less over time, but it can actually help people with debt since they're paying back their loans with money that's less valuable. And that really brings us to our final thought. We've looked at the causes, how it's measured, and the main tools we have to control it. But when you think about all the unpredictable things in the world, from global pandemics to wars, it really raises a big question. Inflation is this constant force in our economy, but can we ever truly keep it in perfect, predictable balance?